If you want to pay your mortgage off faster, this is the video for you. I'm about to be reacting to Doug Andrews' uh how to pay your mortgage off faster. Let's see what he got.
Sending extra
First time
principal
saying this.
payments against your mortgage is not the fastest way to pay off your mortgage. In this episode, I'm going to address the question that I've answered numerous times in different ways: how to pay off your mortgage faster. It's not what you think.
Actually, I've been a part of one of Doug Andrews' his mastermind for years now, the IUL Insiders. So it's my first
I'm
time
Doug
seeing this video though.
Andrew,
Let's see what
and I've been teaching people about how to optimize their assets and minimize taxes and get their house or their real estate paid off the quickest, smartest way now for more than 46 years. I've written several books about it, but it's not what you probably think. I'm here in my radio studio, and I've had a weekly radio show now that's broadcast nationally for 12 years. Prior to that, for 35 years, I helped my own clients get out of debt the quickest, smartest, fastest way. And it was not any way, shape, or form sending extra principal payments to the mortgage company, as I'm going to share with you. But as I began to teach this from 2001 to 2007, I had 4 best-selling books. One became a New York Times, Wall Street Journal #1 bestseller. My books are over here, some of them.
Doug has 4 best-selling books. His first book took him 10 years to write. And that's when he first taught me about the 80-20 rule, how he got the book to approximately 80%. Then he released it to 500 people. He asked for their feedback. They gave feedback. Then he had the second edition, the third edition. By the time he got to a major publisher, it had already had 4 rewrites to the point to where when they got it, they say, "Man, Doug, I mean, this is like a perfect book. Our editors, man, we have to do nothing." And that's because does the 80-20. By the time they get it, he's probably uh made his draft and sent it out to people that he knows, people that he trusts, to get their feedback, and then they let him know about the grammatical errors, that sort of thing. So yeah, but yeah, now he's a 4-time best-selling author.
But I'm going to allow you the opportunity in this episode to click at the link down below and get a copy of my most recent best-selling book that retails for $20. You contribute $5.95 towards the shipping and handling, and I will pay for the book and send one out to you free. It's 300 pages of information, but there is a chapter in there that addresses exactly what I'm talking about right now. But if you want to know and understand, here we go. You know, a lot of times there are all kinds of ways and ideas that people tout how to get out of or pay a mortgage monthly 10 years earlier, or 15 years, or in 12 years. And every one of them seems to talk about
Yeah, that's always the thing, right? When the American dream is to buy the house, and then, based off how the system is set up, you don't got the cash to just pay it all off, so you get a mortgage, But the thing is, all right, once you get that mortgage, pay it off as soon as possible. That's the way you talk.
sending extra principal payments to the mortgage company. So let's talk about various ways that people sort of get duped into doing that. So let me share with you a story. I met one
Duped. All right, so he's already changed the way that you would normally think about this. Like if somebody said, "Oh yeah, I send extra principal payments to my mortgage company so that I can pay it off a lot faster," when the first time you heard somebody say "duped," you shouldn't do that.
day with 3 finance professors years ago at a major university, and they said, "Mr. Andrew, we teach all of our advanced finance students here at the university why, when they go out and they purchase their first home, why they should take out a 15-year amortized mortgage if they can afford the payment, rather than a 30-year amortized mortgage." I said, "Really? Why do you do that?" And they looked at me like, "Well, duh." Maybe they meant Doug, I don't know. They said, if you just bite the bullet and pay a higher mortgage payment, you will save yourself a grundle of interest. You'll have your house paid off in 15 years instead of 30 years. And then you can begin to sock away the same amount of money into an investment like a tax-deferred IRA or 401k.
I know, and I'm one of those people. I know, I know y'all heard the word if you've been looking for a house and you've been around this, you've heard the word amortized before, but you probably don't really know what it means. Amortized, right? For it to be amortized, of course, it's the past tense of amortize. Gradually write off the initial cost of an asset over a period of time. Reduce or pay off a debt with regular payments. So when they say amortized mortgage, it's because you get the lump sum loan and then you write it off over time by gradually paying off the initial cost of that asset with regular payments.
I said, gentlemen, they were three men. I said, gentlemen, you're
It
finance
adds.
professors. Haven't you ever taken the differential between a 15-year amortized mortgage payment, which is higher, and a 30-year mortgage payment, which is lower, taken that differential plus the tax savings you will achieve on a 30-year mortgage, especially the first 15 years of a 30-year mortgage versus the 15-year mortgage, and with a system socked away that differential over into an account, compounding tax-free. Well, right off the bat, they go, it's tax-free. So I had to educate them on my favorite vehicle, which is money free for 40.
I'm going to let you know he's talking about IUL, Index Universal Life.
6 years. I call it the Laser Fund. It is a max funded tax advantaged insurance contract where I have earned rates of return averaging between 6 to 10%. Many years I've earned as high as 16 and even 25% and more. But I've averaged the last 25 years 10.07%. But even if I only earn 6% tax free, it is twice as much as I'm paying net on my mortgage. They said, never heard of that. I wasn't surprised. But they said, no, we've never done that math. I go, I thought so. So I took out my HP 11C calculator, and right in front of them, I did the calculation. And I said, look, they were flabbergasted. By taking the money, they were telling their students to pay in a higher mortgage payment, a 15-year mortgage. Now, it could be a 15-year mortgage, or you just send extra principal payments to the mortgage company. I don't care what method you're using. Instead of doing that, you take that money and put it over here in this pocket, and you're earning compound interest tax-free. This pocket is the simple interest, a declining balance tax deductible on the mortgage. Don't kill your tax deduction. Every time you send.
And what he's talking about is arbitrage, y'all. One of the terms that once if you know Doug, he has a lot of different terms and phrases and things that he uses to make it lock in and make it make sense. Metaphors. He likes to call them sticky metaphors. Just different things that he says. And one thing that he says is a lot of people think there's only two types of people. A lot of people think it's only people who pay interest and people who earn interest, when actually it's three types of people. It's people who pay interest, people who earn interest, and people who understand that you have to pay a little interest to earn a lot of interest if you know what you're doing, if you have it in the right vehicle. What he's saying is if you're paying on a 30-year amortized loan, instead of trying to take a bunch of money and apply it towards the loan uh, in a non-liquid fashion, because yes, okay, you're paying the money off quicker, so you're paying off more of the principal, and therefore you have more equity. And if you and theoretically, if you have an emergency, then you can pull from the equity of that home. Where actually, usually when you need the money the most, that's when it's the hardest to pull from the equity of a house.
Extra principal payments to the mortgage company. It's like saying, hey, here, Mr. Mortgage Banker, is an extra $100 this month. Now, don't pay me any interest on that. If I want that back, I'll borrow it back on your terms and prove there's a need why I should have it. Now, when I word it that way, it sounds pretty stupid, doesn't it? Well, see, that's what's happening. You're not accomplishing anything because the amount of money you put into the house, equity earns a 0% rate of return. It doesn't matter if your house is mortgaged to the hilt or free and clear, it's going to go up or down in value based upon the real estate market. It has nothing to do with how much equity is in there. When I separate my equity or keep it separated, I give it the ability to earn a rate of return. And I can earn predictably 6, 7, 8, 10% compound interest over here in my right-hand pocket. This is in the laser fund that I'm talking about. And the mortgage, which is maybe 6% tax deductible, is only really 4% in my 33% tax bracket because I can tax deduct the interest. And if I
Yeah, what he's talking about, once again, it's arbitrage. So just to reiterate, let's say you have a 6% interest on a mortgage, right? So you're able, and whenever you're paying interest on the mortgage, you're able to write it off on your taxes. So you're writing off 6%, but you're not saving the full 6%. You're just writing it off as it's deductible. So because you were able to deduct that 6%, really what came out of your pocket, if you are in a 20 to 30% tax bracket, was approximately 4%. So if you, instead of putting, what he's saying is, what a lot of people do is they go ahead and, let's say you have that lump sum of money, instead of putting that lump sum of money toward that, go ahead and put it in a vehicle that's earning 7, 8, 10% tax free, compounding over time. Because if every time I gave you $4, remember, because when you write it off, the money that's coming out of your pocket to keep that mortgage going, because remember, the alternative is no mortgage, right? But what he's saying is keep the mortgage going, because not only are you getting that tax break, right? But if every time I gave you $4, you gave me back $7, guess what I would do? I would keep giving you $4. Like if as soon as I gave you $4, you turned around and gave me 7, I would immediately put the 3 in my pocket and give you back that 4. And I would keep doing it until you stop. And that's the principle that he's talking about. Would you rather pay 4% interest to earn 7% interest?
borrow at
What?
4.5% in a 33% bracket, it's only costing me 3. If I borrow at 3%, which I've done on many real estate properties, it's tax deductible. It only costs me a net of 2%. Every $1 million of real estate equity that is not, you can learn about, I am compounding and earning a 9 or 10, let's say 9. So I'm earning 9% compound interest tax free. Over here, I am paying 4.5, a net of 3, or I'm paying 3, a net of 2, because I'm tax deducting the interest. How much more is 9 than 3? How much more is 9 or 10 than 2? It's 3.
He'd be like, how much more is 9 than 3? And I think what he's about to say is, a lot of people say, how much more is 9 than 3? They say 6. Nah, it's 300%.
300%. It's 500%. It's 5 times more money. Again, would you hire an employee for $20,000 or $30,000 if that employee made you an extra? If you do the math, the money you would be tempted to pay to the mortgage company to pay off your house, if you put it over here in this side fund, it will actually compound and grow to enough that these finance professors, they were flabbergasted. There was enough money in 12 and a half years. The 30-year mortgage, 2.5 years faster than the 15-year mortgage. And we actually redirected in the illustration $50,000 of otherwise payable tax to causes they support. In other words, I was able to use a lot of Uncle Sam's money to get out of debt 2.5 years faster. But if I get sick, if I get laid off, if I get disabled, and I have my money over here in this liquid side fund, I can access it with a phone call. If it's trapped in the property, if I pay off the property, there's only one way to get my money out of there. That's sell it. And if the real estate market is really bad, I'm going to lose. And if I pay it in extra principal payments, I have to borrow it back. And when you need the money the worst, it's the hardest to get because you can't qualify for the mortgage if you're hurting. And so I keep my real estate equity separated for liquidity safety, and I actually get out of debt faster than giving it to the mortgage company. But you know what? When I have enough money in my right hand pocket that I can pay it off 2.5, 3 years faster, I physically don't do it. Why would I kill an employee? Why would I fire an employee that's making me 100 to 500% more than they're costing me? When I do that, I can prove to you in this book mathematically that you'll end up with 1.8 million more money. At the end of 30, 35 years, you'll have maybe 3.2 million more dollars in your side fund by not physically paying off the mortgage, because anytime you want, you make a phone call, you can take the money out of here and pay off the mortgage. So my mortgage is paid off in 10 years, in 12 years, actually faster than giving it to the mortgage company anytime I want to. But when I don't physically do that, it continues to compound at 100, 200, 300% more than the cost of the funds. It's up to you. If your goal is to get out of debt, I can get you out of debt much faster than giving it to the mortgage company. But if you want to continue to make more than the cost of the funds, this is how banks make money. They pay us low interest and they loan it back out and earn higher interest. This is what makes the world go round. This is the parable of the talents in the Bible, Matthew 25. When you understand this, you'll begin to understand how wealth is created, and this is what makes the world go round, and you'll be able to end up with millions of extra dollars rather than just paying off the house. In other words, I sleep way better at night with my house mortgaged and the equity that I could pay off the house separated over here, compounding tax-free, because anytime I want, I can take the money out of here and pay off the house. On my balance sheet, it is paid off. This asset will wash out this liability that fast anytime I want.
And what he's talking about is a different way of viewing debt. A lot of people have a strange relationship with that, and I get it. It's just the way we were raised. But you think, all right, if I have it all paid off, I'm debt free. Now, because I have it all paid off, all of this money is stuck in this in the equity of this home, money that isn't liquid, because liquidity means you can get to it within 1 to 3 days. You can't get to that money within 1 to 3 days. Like you said, if it's an emergency, usually you won't be able to qualify for a mortgage. And then so because they're saying, hey, yeah, I mean, yes, you have equity in here, and yes, we could loan you the money using your equity, air quotes, as leverage, but how are you going to pay us back? Right? So now you paid that mortgage off so fast, but then you turn around and when you need the money out of there, you can't get to it. But no, now let's say you can, but when you have an emergency, how quick do you need that money? Do you need it when do you need it? Do you need it in a month from now? Nah, usually when you have an emergency, you need that money today, and you can't get to that equity even if you want to sell it. You're not going to be able to sell it in a day. Uh if you want to borrow, if the emergency is drastic enough, you're not going to qualify for the loan. So it's about putting it in the right order. A lot of people like to look at rate of return first when they talk about where the money vehicle, where they're going to keep their money, but really it's first liquidity, something that you need to be able to get to within 1 to 3 days. Safety, something that you can go to sleep and wake up and not have to worry about potentially losing all of your principal or a big chunk of your principal overnight. Then that's when you look at rates of return, then tax favorability.
But this is continuing to grow way faster than if I take this asset and pour it over here and it earns zero. Because equity in real estate earns a zero rate of return in the property.
And like you said, you're still debt free. If you have a $500,000 mortgage, because you were only paying the minimum, and all that extra money that you would have paid to pay it off very fast, you put it into a properly structured index universal life policy, an IUL. And let's say you got $1.5 million in your properly structured IUL cash value, but you have a $500,000 mortgage. Are you in debt? No, because at any time that you want, you could pull $500,000 from that cash value and pay that house off. Only difference is instead of all of that 500,000 just being sitting there and not allowed to accumulate in value to grow to that larger number, instead of that $500,000 just sitting in there in the equity, you actually had it over here growing, where you can access it when you want to in an emergency.
It's going to go up or down in value regardless of whether I pay it off or whether it's mortgaged to the hilt. Does that make sense? If this is arousing curiosity, I want you to.
And yeah, and Doug is about to tell you to check out his book, The Laser Fund. Definitely check that out. Now, like I said, I'm a member of the IUL Insiders. Doug has been my mentor for multiple years now. He doesn't sell life insurance. Right now, first you make the cake, then you sell the recipe, right? All truths are parallel. So now Doug is in the sell the recipe stage of his life. If you want to learn more about these properly structured index universal life policies and how you could potentially use a strategy to, like Doug was talking about, to you saw how he got you. If you how to pay off your mortgage faster, right? And he did tell you how to do it, even though you technically, if you followed this strategy, would still have a mortgage, because you didn't do what traditional thoughts might tell you to do, is put it all into this illiquid vehicle. You moved it over here into a properly structured index universal life policy so you can reap the benefits of Internal Revenue Codes 72E, 7702, and 101A. As long as this is considered a life insurance policy, it grows tax deferred, 72E. As long as you access the money the right way, you can utilize it tax free while you're alive, and it won't be considered income, 7702. And whatever you have left in it after you pass away will blossom to a larger number and pass to whoever your beneficiaries are, tax free. 101A. I have been Randolph Love III, and as always, it was my pleasure to listen and watch one of Doug Andrews' videos. If you want help with a properly structured index universal life policy, check out ShieldWolfStrong.com, ShieldWolfStrong.com, and set an appointment. You can 100% virtual. It can be a phone appointment. It can be a video appointment, or you can do it contactless. Quote, if you know, I know a lot of y'all like to just text and email, no phone calls. You can take over the world as long as you don't have to make a phone call. So don't worry about making a phone call, but touch bases with us and follow. Make sure you comment, like, subscribe. What do y'all think about his strategy to pay off the mortgage? When you grew up, were you told pay it off as fast as possible? And to did you ever have an emergency to where you couldn't get to the equity in your home fast enough? Maybe you eventually got to it, but it wasn't as fast as you needed it. Randolph Love III signing off.